All right, let's dive right in. We're looking at a fascinating document today. These are the U.S. Market Peripheral Notes, dated for Thursday, March 12, 2026, and they paint a picture of a market that is really on edge.
This video presents a direct informational narration of the source document.
Okay, before we get into the thick of it, we have to do the usual but very important risk notice. Remember, all of this is for informational and research purposes. It is absolutely not investment advice. Investing has major risks, prices can go wild, and what happened in the past tells you nothing about the future. So here's the game plan. We'll kick things off with a big picture market overview. Then we'll get to the heart of the matter, the geopolitical crisis and the energy shock. After that, we'll look at domestic data, the market's technical wiring, and wrap up with a look at some individual stocks and the report's final take on how to respond.
First up, the market overview. And the theme of the day is a big one: systematic repricing across global risk assets. You know, that's just a fancy way of saying there's been a fundamental change in how investors are valuing pretty much everything. Let's break down what that really means.
So here's the chain reaction. You've got the US dollar, treasury yields, and oil all spiking at the same time. Now, sometimes that can signal a strong economy, right? Not this time. This is the market pricing in the risk of stagflation. The fear is that high energy prices will fuel inflation, which in turn keeps pressure on equity multiples. It's that rising yield on treasuries that's the tell. It's not about growth expectations, it's all about inflation.
And you can tell a lot just by how the day ended. The sell-off didn't just trickle out, it sped up right into the close, pushed over the edge by algorithmic triggers. You know, closing at the absolute low of the day, that's a classic sign that the sellers aren't finished yet. It fits this classic Thursday sell-off pattern where the big institutions just want to get risk off their books before a weekend full of uncertainty.
Now, this is a really interesting detail. At one point during the day, there was a headline about Iran offering partial navigation through the strait. You'd think the market would jump on that good news, right? Well, it didn't. The response was totally muted. And here's why. The big traders saw it not as a de-escalation, but as a selective pass for some countries, which they felt actually made the whole geopolitical situation even more tense.
And that brings us right to the main event, the source of all this market anxiety. The geopolitical crisis boiling over in the Strait of Hormuz and the energy shock it's sending through the system. The whole thing really blew up with a televised address from Iran's new supreme leader. He called for Gulf states to shut down U.S. military bases and made it crystal clear that closing the strait was a deliberate tool of strategic coercion. There was no ambiguity there. This was a calculated move.
And the data coming from the ground was just as bad. You had 2 foreign oil tankers attacked, Iraqi oil ports completely shut down, and get this, even a record 400 million barrel release from the Strategic Petroleum Reserve did nothing to lower prices. Why? Because you have a transport paralysis. It doesn't matter how much oil is available if you can't ship it. On top of that, we learned U.S. naval escorts won't even be in a position to help until the end of the month.
So the big question is, where does oil go from here? Well, the report lays out 2 very different scenarios from major banks. Goldman Sachs has a base case where the disruption lasts about 3 weeks and things normalize, with oil falling back below $70 by early June. But then there's the extreme case. If this blockade drags on through the end of March and leads to a ground conflict, oil could surge past $150. And that's where the real tail risk comes in, that low probability but massive impact event. Both JP Morgan and Morgan Stanley are putting out warnings. They're saying if there's no diplomatic breakthrough before the weekend, we could be looking at a U.S. military ground intervention. The risk of this spiraling is very, very real.
Okay, let's pivot back to what's happening here in the U.S., because domestic factors are making this whole situation even trickier. We need to talk about some key macro data and 2 huge policy shifts, one on tariffs and one at the Federal Reserve itself.
So here's the complication. The U.S. economy itself is still looking pretty solid. Initial jobless claims actually came in a little better than expected at 213,000, and the trade deficit for January narrowed to $54.5 billion. Now, why does that matter? It matters because a resilient economy really ties the Fed's hands. They have very little cover to ride to the rescue and ease policy if the labor market is still this strong.
And on the policy side, 2 absolute game changers. First, the administration restored a 15% global tariff. That's not a temporary thing. That bakes a durable inflation premium right into the economy. And second, Fed Chair Jerome Powell's term is up in May. The market is already assuming his successor will be someone more likely to pursue politically driven easing, even if inflation is still a problem.
Okay, now we're going to get a little technical.
Let's go under the hood and look at the market's plumbing, the microstructure. Because things like zero-day to expiration options and this concept called negative gamma are pouring gasoline on the fire. In a fragile market like this, everybody is watching the exact same technical levels. The first domino to fall was 6750. Once we broke that, it triggered systematic deleveraging from big computer-driven funds. The next line in the sand is Monday's low, 6636. Think of that as the last psychological defense. But the big one, the one the report calls the Normandy defense line, is 6600. That's the key put wall, and it just so happens to overlap with the 200-day moving average. It's huge.
So, why is this selling so aggressive? A big reason is this condition called negative gamma. Here's the simple way to think about it. As the market falls, options dealers, the folks who sold all that downside protection, are forced to sell index futures to hedge their own risk. But that selling pushes the market down even further, which in turn forces them to sell more. It creates this vicious, self-reinforcing downward spiral.
All right, let's zoom in a bit from the big picture chaos and do a quick scan of some specific sectors and individual stocks that the report highlighted. It's all about valuation getting repaired and risk being priced in.
You've got a lot of different stories playing out. Adobe or ADBRV is getting hit because its CEO just left and the market's having to recalibrate that management premium. Meanwhile, fertilizer stocks like CF, MOS, and NTR are actually rising thanks to natural gas costs and policy hopes. HIMS is getting a boost because a big lawsuit from Novo Nordisk was withdrawn. Salesforce, or CRM, is finding support from a massive $50 billion buyback. FLY Firefly got a huge credibility endorsement from a partnership with Lockheed Martin. And BMBL or Bumble is bouncing, but it's mostly short covering after earnings were weak, but hey, not as bad as feared.
And that brings us to the final section, the conclusion and what the report suggests as a trading response. They've even got a memorable subtitle for it, Survival Rules Under the Trump Taco Effect. The trading guidance here is very specific. The idea is to maybe start an initial, small position if the S&P retests that 6630 area. Then, that core defense level at 6600 is where you might add to it, and the stop loss? Strictly below the 200-day moving average. The overall rule is to use small position sizes. This is about dynamic defense, not trying to be a hero and pick the bottom. And they add a really unique risk warning. Beware the taco effect. That's their term for a presidential tweet potentially triggering a violent short squeeze out of nowhere. And really, it all boils down to this one final core view. This is the main takeaway. Until that dangerous negative gamma environment we talked about finally reverses, the number one rule is to avoid taking oversized positions. The risk is just too high.
And just to wrap things up, here is the full professional risk disclosure one more time. Remember, this has all been for informational and research purposes only. It is not financial or trading advice. Any investment decision you make is at your own risk. Thanks for tuning in for this deep dive into a very, very choppy market.